So Abir there talking us through the Middle East events. That's pushing oil prices higher. We're back to worrying about inflation. I'm not sure it ever left our consciousness, but oil prices heading, well, back towards $100, it would seem. What are you watching in terms of that inflationary dynamic?
Yeah, I think in the very short term, yields should be higher again. So we're seeing yields higher across, everywhere today. And I think, if you take the US curve as kind of the benchmark, which is maybe debatable because they've got a different policy from the central bank. There's about 3 basis points higher across the curve. I think in the short term it can go higher again. I think everything in the very short term is quite inflationary. I think you've had strong data. The ISM was really strong on Monday. We had the Gilts data, and the Gilts data is very backward looking, but still it's showing that the jobs market is holding up. We've got this idea that the markets are very strong, and that at the moment the AI impulse is inflationary, even if it's ultimately the production boom is going to be deflationary, which is still in debate. And now you've got the Iran conflict flaring up. So everything in the short term suggests to me that yields should be going higher. Now, I do accept that the beta for the yield move to inflation is lower because there's a bit of a stagflationary kind of whiff around this impulse at the moment. So people are worried about if it is the Iran conflict that's driving it, isn't that quite bad for the long end? So I realize it's a bit more nuanced, but I still think the short-term dynamic today is yields higher. And obviously, that's more problematic for things like gold, Bitcoin, other speculative assets like that.
What stops the US 10-year getting to 5%?
I think it probably will go there, but just not quickly. I think
why not quickly?
I tell you why. Because it stops because there are enough market participants who have an interest in accumulating, coupon assets or fixed income assets that basically when they think that there's a reason to pause, yeah, exactly, they kind of choose a moment to pile in, and they tend to work in kind of tandem. So if you get to a certain level and they're like, okay, it's time to buy a load of fixed income, and then that's where you get these pause and these fixed income moves. It's why every single, we've seen this the last couple of years. We've seen a very steady trend in a bond bear market, and we're still in that bond bear market. We're still going to see much higher yields over the long term. But I think one of the lessons of the last few years is that it doesn't happen in a straight line. It happens quite violently, and then we get these dip buyers come in bonds, and they buy it, and we pause for another few months, and then we get the next catalyst, whether that's inflation or fiscal side. So I do think that ultimately we're getting there. I just don't think it's a rush there.
Do you think the moves into gilts have been relatively well bid in recent weeks here in the UK? There has been moves in. Maybe that's a kind of a repricing around some of the political risk. Maybe the markets have got over their skis in terms of how far the BOE might go in terms of their expectations. Are the gilt markets looking slightly distinct at this point?
I think in the UK, there's probably a stronger growth fear than other places. Yeah. It's how much can the Bank of England actually get away with hiking? If they, I think our colleague Van Ram has literally just put something out in MLIV only about 10-15 minutes ago, just kind of going hey, the Bank of England by Taylor rule can only do 35 basis points. So why don't you get the hike in as soon as possible? And that might stop them having to do more later. But I think there's more of the kind of the growth concerns there. I think the UK is kind of weird that it's lost a little bit of its international sheen, but it still has a very strong domestic sector of long-term, real asset managers, pension funds, who need to, again, buy those dips at certain income reasons. So it's a kind of slightly weird dynamic that it gets more extreme panics, but it has a strong domestic bias to buy those dips.
Mark, thank you very much indeed. Bloomberg Markets Live Executive Editor, of course, Mark Cudmore. And a note for terminal users, Anna, Guy and I will be joining the Markets Live team for an event, Money and Macro, tomorrow, 5 p.m. here in London. Terminal users can catch that using the function Live Go on the terminal.